Hi team. In this video, I want to explore a budget revision template. I thought it would be a timely topic to address because as of the recording of this video, the coronavirus continues to spread globally and businesses across industries have been affected. Consequently, budgets prepared at the conclusion of last year are likely worthless, and I thought this template might help develop a framework that would facilitate making difficult decisions in an uncertain time. So let's jump in with the tab titled Budget Revision. This tab provides an income statement that will allow us to make changes to revenue and then evaluate the company's profitability under the current cost structure, and if necessary, make changes to work towards a new cost structure to improve the company's margins in this revised revenue scenario. To fit all of this on one screen, I've grouped many of the rows and columns. As I explain how to work through the workbook, I'll ungroup what is necessary. So let's start to explore some of the detail. If we expand the group selection for total revenue, in rows 11 through 14, you will see inputs for your original budget. And then beneath that, in rows 19 through 22, we have percentages that can be applied to the original budget to develop a new top-line estimate, which you can see below. Whenever you want to maintain the original budget, input 100%. And if you want to show a decline, as we do here beginning in March, you can start to slowly or drastically reduce these percentages. And this will give us a new total revenue line. Next, we have included the ability to run a sale through the budget. To make it a little bit easier to view, I'm going to collapse some of the historical period. And otherwise, this is pretty simple. Input the percent discount you would like to apply to each revenue type, and the sum will be subtracted from total revenue to arrive at net revenue. Now, all of this is entirely hypothetical, but in this model, I used the sale discount to demonstrate that it might be a useful tool to get customers to re-engage after a lull in business. In the prior month, revenues dropped to 15% of budget, and in September, with the sale, it rises to 45% of budget. Again, entirely hypothetical, but just a scenario you can run. And this is entirely for demonstration purposes only. Next, we can move on to cost of goods sold. So let's first expand the selection and the COGS assumptions. And finally, to review the formula, we'll require some additional inputs. So now we can review the formula used to project almost all expenses in this model. The bulk of this formula is explained in two videos that are included as links just beneath this video. But I do want to comment on two additional features. The first is that the fixed rate now has two options. If you scroll down to rows 152 and 153, you can see that you can choose between flat growth and 2.5% year-over-year growth. The second additional feature is the cut period. And what this allows us to do is eliminate the cost in its entirety. And the way we did this is with an if statement. You'll know that the formula reads, if G55 is less than the value in U7, then return the value 0. And if that statement is false, then return the formula we're using to project all expenses. And I can quickly demonstrate how that works by inputting the value 15 in cell G56, and you'll note that the expense is eliminated in the following period. This can be dangerous if used excessively, but if aggressive cuts are to be made, there may be some line items that need to be temporarily or permanently removed from the budget on a go-forward basis. After that, once all line items have been projected for COGS, they're summed below in row 63. Continuing to move down the income statement, next we have gross profit, followed by SG&A. SG&A is projected largely the same way that COGS is projected, with one exception. Per the note in row 81, payroll is projected on a separate tab. So let's take a quick look at this tab. And we can zoom out to make it a little easier to view. And once you take a closer look, you'll realize it's the same approach we use to project revenue. Here we have the original budget, percentages to apply to that original budget, And then we take the product of both to develop our new projection. And then at the bottom, of course, everything is summed. And it's row 134 that links back to the tab Budget Revision. And I thought this approach would be helpful because it allows you to manually reduce salaries in the event that the team is open to reduce pay for a period of time. So let's go back to Budget Revision and continue working down the income statement. And from here on out, it's really pretty straightforward. You have earnings before interest and taxes, less interest expense to arrive at earnings before taxes, less tax expense to arrive at net income. And that's about it for this tab. In part 2, we will focus on the tab titled Cash Flows. But for now, you're done.